Welcome to another episode of The Change, where we introduce you to people and ideas shaping MENA region. We have a very interesting episode for you today because our guest is a co-founder of Online Training Campus. The reason why this episode is so interesting is that around a year ago, we shot the episode with his brother, a co-founder of Online Trading Campus, and at the time, he warned us about the stock market crash. At the point we didn't know about coronavirus. So today we're going to reflect to that, and we are going to discuss about what the future holds for us when it comes to stock markets. So without further ado, I would like to welcome my guest today, Mr. Jan Skorpuniski.
Thanks for having me.
It's good to have you here, buddy. So it was, first of all, the idea for this episode came because of the episode that we did with your brother around a year ago, and it's super interesting. We're going to leave the link in the description below, when Bernd basically told us what is going to happen, not knowing that the coronavirus is coming. And you guys are one of the rare experts, or at least in my circle of connections and network, that is giving such a precise estimates on what is going to happen with the stock market. And I'm sure there is some kind of a method to that madness. So what do you have to say about it?
Yeah, well, first of all, I'd say that, in my many years of trading experience, I've become extremely humble in the way how I look at the financial markets, and especially when it comes to my opinion about the financial markets, because I've really learned the hard way, and I understand that nothing is really 100% certain. Nothing is really impossible. It's always about probabilities. So if you, for example, today buy an investment program, it will say at the bottom with this little caveat, past performance does not predict, future performance. So just because you were right in the past doesn't mean you're going to be right in the future. So I'm really a big fan always of following the arguments rather than the past performance. And that would also be my first suggestion to your listeners today, is to follow my arguments and focus on my arguments rather than my past performance. Because if you navigate in the financial markets long term, you'll be a lot more sustainable doing it that way, because it goes, as per the philosophical principle sapere aude, which we basically live by, which means have the courage to use your own mind, which in the world of trading is a must.
And I mean, the whole idea about trading seems very exciting for a lot of people, and I think it's based on my circle of friends as something where people feel very confident stepping in, but not a lot of people actually make a lot of success. And as you said, trading is more factual than more based on facts than on the assumptions, right?
Yeah.
And one can burn fingers if they try to play it on the feeling, right?
Exactly. I mean, a big mistake that a lot of people do, especially in the beginning, is going with the herd.
Yes.
And if you go with the herd, that's when you get kind of broken, right? That's when you walk into a mess.
Yeah.
Because also Warren Buffett once said that if you invest in something that's popular, don't expect to do well.
Yeah.
And because during those times of markets becoming hype, that's the time actually to get out of those markets, right? Because at that time, it's just way too late. I mean, if you, for example, look at Bitcoin in the year of 2017, 2018, everybody was saying, well, let's buy Bitcoin at $20,000 because it's going to go up to $100,000. I mean, no. I mean,
didn't happen.
It didn't happen. It may happen eventually.
Yeah.
It may happen 10, 20 years from now.
Yeah.
But these kind of exaggerated market moves are usually not sustainable. It's gravity. What comes up has to come down eventually.
It's too good to be true.
It's when it sounds like it's too good to be true. It usually is. Yeah, it usually is.
Definitely. So obviously the whole crisis, not only about the markets, but caught us all off guard, and nobody was really prepared for it. You guys saw that the market crash will happen. How do you guys see that? How do you guys predict that something like that will happen?
So, I mean, people usually, when they think of that kind of prediction, they think like we have a glass bowl or something that we look at and we predict that to happen. But it's actually not like that. I mean, we just look a lot at fundamentals and technicals. So to really understand when a market tops out, you have to become an expert at technicals, what we call supply and demand. Now, technicals, that's a very complex way of analyzing the markets, where we spend the most time with our students on acquiring the skill and how can you apply that to the charts. Many people don't believe it, but financial markets are extremely technical. And technicals just help us to time the markets, right?
When you say technical, just to kind of unpack that, what do you mean by technical?
So technical chart analysis.
So basically numbers. You're just following and reading the numbers.
Charts, basically.
Charts.
So you have two ways of analysis. You have a fundamental analysis and a technical analysis. Now, fundamental would be looking at numbers, looking at the economy. Technical would be purely looking at the screen and the charts, the beautiful charts that you see, and making sense of them and reading them, being able to see what's happening in those charts. So oftentimes technicals you can basically see as a roadmap. Oftentimes technicals will align in a way where it gives you a roadmap for you to position yourself in a certain way. So, and that's purely due to the fact because banks and institutions who have the most money, who run the markets, they position themselves. And when they position themselves, they basically leave these breadcrumbs, right? And for you, it's just, my job is to understand the breadcrumbs for what they are, make sense of them, and then understand how they position themselves so I can position myself with them as opposed to against them. And that's exactly what happened back in February. The technicals aligned perfectly, and I'm literally on tape back in February calling for the Big Short 2.0. And so basically what we do at our academy is we have these live trading sessions on a weekly, daily basis with our students, so they can basically dial in every day, every week, and they can watch us do the analysis live, the technical analysis, the charting analysis. And they can also copy us, right? We call that earn while you learn. And at the same time, we record those sessions and we save them in the library, in our library. So basically for transparency reasons. So looking back to February, I basically said something along the lines of, let's all position ourselves short now, right? Because the markets could crash, and when they crash, everybody's going to talk about the Corona crash. But when people talk about the Corona crash, it will be too late because the market will have already dropped at 30-40%. So we need to do that beforehand. But technicals are just one side, right? The other side is fundamentals, what we talked about earlier. There are a couple of fundamentals that we can talk about, maybe 3 that are really relevant to the general investor. But fundamentals, what they do in general is they give you this macro bias in the market. Okay, what do I mean by that? They allow you to analyze the market in a way where you're going to say either I'm macro bullish or I'm macro bearish. Now, for those of your listeners who have never heard bulls and bears before, those are terms that those are terms that come from the Stone Age floor trader world.
So Manhattan.
Yeah, well, Wall Street.
Wall Street.
Exactly. So back then, if you look at a bull, how does a bull attack its prey? With his horns, and it throws a person up. Right? So a bull.
So that's basically what you see on the
markets going up. So a bull is a person who thinks that markets are going to go up. A bear, how does a bear attack its prey? The opposite way. Top down, right?
Down, yeah.
So a bear is somebody who believes that prices are going down. So fundamentals, what they do, they are very bad at making you time the market, allowing you to time the market, but they're very good at giving you that macro bias, macro bullish or macro bearish. Now, for example, you have something called a Warren Buffett indicator. maybe we can talk about that later. You have something like an inverted yield curve. You have something like cycles. And all of that basically if you look at them combined, they basically give you a warning sign if something is overvalued, you would say, in the world of trading.
Okay, so the general conclusion, what I hear here, there is a lot more science to this than
There's
what most people would think of. So talking about the crisis today, we've been through this for previous 4 or 5 months. What's the roadmap for this crisis going forward?
So I believe we're going to see an unfolding of the current economic crisis, which is going to be unfortunately unstoppable. For that, the economy is just way too damaged. Now, the COVID-19 measures in terms of lockdown, they by themselves were not the only reason for the current economic crisis. They were just, we would call it the trigger or the catalyst. So let me explain this maybe a little bit more. So if you have an economy, you can compare an economy to a COVID-19 patient. So if you're doing well, you're healthy, and you have no preconditions, you get COVID-19.
Yeah, you'll be all right.
You'll be all right, right? Yeah. You're going to recover soon. However, if you're unhealthy, you have preconditions, then you get COVID-19, then you have severe symptoms, you may need hospitalization.
So that's basically the economy. The economy was not ready and healthy enough for something like Corona.
Exactly. So prior to COVID-19, the economy was already unhealthy. It had a lot of preconditions. For example, the banking system in the US. In there, you had a lot of accumulated imbalances that couldn't unfold in the form of zombie companies. And these accumulated imbalances became very clear once the Federal Reserve, who's the Fed, the central bank in the US, when they stepped in and they basically bailed out banks from September to January because they intervened and they injected $500 billion into the banking system from September to January.
Wow.
So
500
billion.
Billion. So
for the banks
millions, it's billions.
Billions for the banks not to collapse. So if you ask me if that's a warning sign, if that's any sign, well, yes, definitely it's a red flag.
Big red flag.
But I also have to tell you, ironically, the financial markets during the same period went up into all new highs and rallied 5 to 10%.
Wow.
Which doesn't make sense, but inadvertently, this rally was created by the Fed and the excess liquidity that was being pushed into the market.
So I have 3 questions that I picked up. First of all, you mentioned zombie companies that we'd like to understand a bit more about what are the zombie companies. Then you said the central banks have basically injected $500 billion in the banking system. I guess those are printed money. And what are they doing with all of that money? But okay, one by one, what are the zombie companies?
So zombie company is a term that comes from Japan. And in Japan, the Japanese stock market went into a hyper bubble in 1990, from which it eventually crashed, and it went down by 40%. It's still down by 40% now, so 30 years later.
Wow.
So a zombie company is really a company that's not yet bankrupt, but they're so deeply indebted that they will never catch up again.
Wow.
So they're basically debt companies, and the only way they're surviving is through refinancing of their debt and accumulating more debt through low and negative interest rates, because debt doesn't cost any money for them anymore.
Are those companies usually of kind of a government interest, or who would finance that kind of company?
Banks.
Banks,
yeah. I mean, a lot of them are relevant companies. A lot of them are mid-sized companies, also small companies. The problem with zombie companies is that they are inefficient. They produce things that nobody wants or needs, or they do it for a price that's just way too expensive. And the problem with the zombies is that they basically zombify the economy, because at some point, no more companies go bankrupt. They all just refinance. And when no more companies can go bankrupt, that's bad because inefficient companies actually should go bankrupt. That's just a healthy process. And if it's just 1 or 2% of the economy can digest that because it then flushes out this bad debt, these bad inefficiencies, and it creates room for growth and innovation. And if that doesn't happen, you then have these zombie companies accumulating in the books of the banks, which is extremely bad, first of all, for the banks, but also bad for the overall economy, because now, for example, in Germany, you have 15 to 20% of zombies. And
15 to 20%.
15 to 20% of all the companies in Germany are zombie companies. They basically are so deeply indebted that they will never catch up again.
And how is that influencing the overall state economy?
Well, it's influencing the economy once you have a trigger that makes those companies fall. And once those companies fall, it creates a knock-on effect. And then there's so many companies falling that it's not manageable by an economy anymore. And policymakers and central banks, they really understand that this is happening, because that's why we don't go back to normal interest rates, right? Because interest rates is really a lever. They should be able to increase them and decrease them depending on what they want to do. But now they can't increase it, because if they increase it, they know just marginally these zombie companies would just go out of business right away. That would be doomsday tomorrow. So they cannot, because even governments, even entire countries like Italy are so deeply in debt that if you increase the interest on their debt, they would just be insolvent. And that would be mayhem for the banks, because the banks have all these bad loans in their books, right? And not just the bad loans of the zombie companies that are bankrupt, also the ones that are potentially going to be bankrupt now until the end of the year, because they're now just simply running out of money. They're somehow, surviving now with the Fed printing more and more money, but at some point they will run out. They will be bankrupt. And the employees that are now unemployed, that also have a lot of private loans, like student loans, mortgages, auto loans, you name it. So for the banks, that's like the worst case scenario. And that's why they know that this is happening. We can never go back to a normal interest rate. But for us as investors, understanding that now we're at 0% interest rate in the US, understanding that that we are potentially going into negative interest rates, that has very...
How can we go in a negative interest rate? That means someone pays you to get money.
Exactly. So you go basically...
Where can I get that kind of a loan?
You go to the bank and you say, how much do I get? And how much do I get as a result? Right? So awesome. You have that in Switzerland and you have that in Japan.
At the moment
already. At the moment.
Wow.
At the moment. So that's my future prediction is that
you're going to move to Switzerland.
Ideally, right? Switzerland is also a nice place to live, very, very close to home as well.
Yeah.
But if you can make that prediction that negative interest rates are also happening in the US, then for you as a trader and investor, this has major, major trading opportunities in some of the asset classes, right? Which we can maybe talk about a little bit later. Obviously, I want your listeners to keep tuned in. But it all kind of is interconnected with another.
Okay, too many questions, not enough time. But you said that central bank is printing a lot of money, and then they're giving money to banks, all right? And then banks are supporting businesses, I guess. But where is all of this money going? This $500 billion that they injected.
Yeah, good question. So these $500 billion in specific, they were going into the repo marketplace. The repo marketplace is an overnight funding marketplace for the banks. It's like a very abstract marketplace, but it's very, very crucial for the banks because that's how they fund themselves overnight if they have shortages in terms of liquidity. So basically, it means that you have this interconnected banking system, these four banks, and they lend each other liquidity if one is short. Overnight, and in return they get securities for very, very low interest. So it's a very cheap way of borrowing money overnight if you need the liquidity. Now the banks stopped lending each other money for some reason, whatever the reason is. We don't know the exact reason. It must be that they stopped trusting each other because they saw they had some bad loans in their books, and what if something happens overnight? I'm not going to give you this. So as a result, the interest rates just went through the roof. And then the Federal Reserve had to step in to calm everything down and pour just liquidity into that market, and this liquidity was just being used by the banks overnight, and then it went forth and back.
I see. How do you explain this interesting situation where the market went up after the crash?
Now,
so if that's correct, right? The market went down as soon as the lockdown came in, but then
it shortly went up. Yeah. So we have to speak about a few things here, and that's first of all, we're inside a recession, global official recession.
Is this as they say, the biggest recession since World War II?
Yeah.
This is by the numbers, by all of the statistics.
By the numbers, by GDP decline, by unemployment. This is the worst recession since World War II. I'd even compare it to the Great Depression of 1929, because back then you had 20% GDP decline. Now GDP results on Q2 just updated them last week, and it was more than minus 30%.
Wow.
So it's actually worse. And then in 1929, you had 20% unemployment. Now we just have above 10, so 12 in the US.
Is the economy today kind of in a better shape to survive this kind of depression than it was before, or it's the same?
Yeah, I mean, the tools that the central banks are using now are tools that they haven't used before. Does that mean that the people are doing better? That's up for question, right? I mean, the second thing that then you have to talk about is this rally inside that recession, right? So that rally inside a recession is a normal thing. It happened in 2009. It happened
rally
in 2000.
Is when it goes down, and then
rally is when it goes up. Drop is when it goes down. Rally is when it goes up. So a rally inside a recession is normal. It happened in 2009. It happened in 2000 .com bubble. It happened in 1929. And it has a name. It's called the relief rally. Why is it a relief rally? Because the market is going up to an extent where after the first shock of the crash, people are now relieved. Investors are relieved. All right, now we can go back to normal. Right now, everything is fine again. It wasn't as bad as we had thought, and let's just, go back to normal.
I see.
However, if you look at the scripts of the past recessions,
they all had the same thing.
They all had the same thing. So in 2000, for example, .com bubble, markets crashed by 40%, and then it rallied by 40%, and then it had a second wave of selling, and then it went down by a total of 80%. And then it took the market 16 years to go back to those prior highs.
Wow.
1929, 50%, 50%, 80%, 35 years to go back to the prior highs. So these relief rallies are normal. And the size of the relief rally is part of the size of the first drop. So the bigger the first drop, the bigger the relief rally. However, the relief rally that we're talking about now has been very much exacerbated by the liquidity provided by the Fed. So the central bank is has basically poured $3 trillion into the financial market within 3 months through intermediaries like BlackRock, which are asset management firms. And because of that, the rally has been exacerbated to an extent where you can now say we're in asset bubble territory again. Because the definition of an asset bubble is if asset prices are vastly exceeding the underlying economy, that's an asset bubble. And that's exactly
what happened in United States back in 2000. And was that an asset bubble?
Yes.
A real estate market crash, right?
2009 was an asset bubble. 2000 was an asset bubble. February last year was an asset bubble. Now again an asset bubble. The difference is we're inside a recession, and we are in an asset bubble which has never been seen before. So that's very much unprecedented.
It's pretty interesting to see what's going to happen next.
Yeah.
Before we get into what is going to happen next, maybe we can make a projection today, and then we shoot another episode in a year.
That would be
But
ideal,
a lot of people are saying that this is the time, and if you watch the entrepreneurs of this world and the richest people of this world, they all say this is the time when you make most of the money, and this is the time when you can make the biggest wins. How does that happen, and how do they? Okay, Warren Buffett is one example, but there's a lot of similar individuals in the world. Well, not a lot, but there is a group of people. How do they make money, and what they do now? How can we all make money like them?
Okay, so it sounds so easy to make money in the financial markets, right? So a lot of investors are approaching this very, very differently. But Warren Buffett, for example, is not invested at all.
He didn't invest anything.
So right now, him and his team, Berkshire, they have a record amount of cash. So they have $139 billion in terms of cash just waiting for an investment. So if you think about it, why does he have so much cash? Why is he not investing? Because he thinks, well, either he thinks markets are going to continue to drop, or he just doesn't find longer term investing opportunities, which goes probably hand in hand. Now, you could also say, well, Warren Buffett, compared to 2009, the housing bubble, he was fully invested. He only had $29 billion of cash.
Only.
So not only for him, that's like only. For me, I wish I had that amount of cash, But now he has 4 and 5 times that amount of cash. Back then he was invested, now not. Why didn't he invest during the crash? Well, if you read in between the lines, then it must be because he thinks this is just a relief rally. And once the second wave of selling kicks in, then he hoards all his cash so he can invest and buy, and he can buy cheap. So Warren Buffett, once said, I want to buy $1 for 66 cents. Right now, you would be buying $1 for 150 cents, for $1.50. So you would be paying premium for $1, but he wants to invest when he can pay discount for $1.
I see. So what happened is that the market crashed and was a rally. What is expected to happen next now, and when would then be the best moment to think about investments and?
Yeah. So a few things that maybe we have to talk about here to understand what can happen next. We would really have to talk about a few fundamental things, like, for example, the Warren Buffett indicator. So you just spoke about Warren Buffett. So he also came up with this indicator called the Warren Buffett indicator. Now, this indicator looks at the market cap to GDP.
Okay.
So if I'm saying that asset prices are vastly exceeding the underlying economy, I say market cap is vastly exceeding GDP of an economy. So right now we are at north of 170% market cap to GDP. This has only been seen 2 times in the past 50 to 80 years. Once in February last year, prior to COVID-19, which was a warning sign for you to say, well, markets are overvalued. You want to be a seller. Warren Buffett indicator is really high. And another time was 2000.com bubble, which was also scratching 160%, which we know wasn't sustainable. Markets crashed and took a long time to recover.
So ideally, who recognized that sold all of their assets stocks before the crash happened?
Right. So these fundamentals don't tell you to sell now or buy now, sell tomorrow, buy tomorrow. That's what you have the technicals for. But they give you this macro bias. So they give you an understanding of, hey, markets are now overvalued. You want to be in general a seller. Doesn't mean sell tomorrow, because there may still be upside opportunities in some markets, in some stocks. But it gives you this general outlook. It gives you a little bit of context.
And it depends what type of investor you are. Are you daily trading or a long-term?
Exactly. What kind of time frames are you looking to make money? Are you looking for like monthly investments, yearly investments? So if you're looking for yearly investments and you're buying now, is the worst kind of time you could look at, because you're chasing valuations of north 170%, which is higher than last February, higher than 2000, inside a global recession. And things are different now than they were even back in Feb. Back in Feb, everything was seemingly fine, right? You had all-time low unemployment. Now you have 10% unemployment. So if you are looking to, invest now in a time frame for multiple years going forward, then now is not a good time to invest because market valuations are just way too high. You cannot be chasing these high market valuations as a yearly investor. However, if you invest something that we call weekly income, looking to make money like with weekly trades, then yes, of course, for a week, potentially markets are gonna continue to rally.
To rally.
Yeah.
Okay, yeah, interesting. I think that's the probably one of the biggest differentiators, whether you're trading for like 20, 30 years and Warren Buffett is investing like projections of 10, 20 years and whether the company will continue to grow long term. So what can we now expect as a next couple of steps with the market by the end of the year, for example, beginning of 2021? What can we see?
So there's going to be two phases really in the near future. There's going to be a deflationary phase,
which is,
and an inflationary phase. So both phases are really designed to take out the money out of your pockets. So the hardworking employee that maybe has money saved and stored in form of cash in the bank or under the mattress, right? Or the conventional investor who buys and holds now, chasing these high valuations. They are basically going to be robbed of their money. Now, deflation and inflation, let's go through both periods because they're important. First, deflation, because that's the first period that's going to happen.
After the rally is kind of over.
Yeah. The next top, once the next top is in place, we are likely to go into a deflationary period, and that's potentially happening towards the end of the year already. However, it's really tough to time because, again, you need the technicals to be really timing that, right? The fundamentals are in place, but the technicals are still not in place. So right now, the technicals still say very bullish, but that can change within a month. So I would say, if I had to say a date, probably towards the end of the year, but could be, plus minus 2 quarters. So deflation means or comes with a collapse of all the artificially inflated asset bubbles, which include stocks, real estate in some territories, and bonds as well. But also you will have a lot of other assets under pressure, like safe havens like gold and silver, which usually perform well during economic uncertainty. Which, by the way, gold is at an all-time high right now. $2,000 per ounce.
What makes gold a safe bet? What makes it so stable?
The fundamentals of gold. Gold has always been perceived as a currency, and because it's naturally limited in quantity. So because it's naturally limited in quantity and it's always had a value, it's just perceived as for investors as a safe haven. Because if things go bad, you can always have gold, right? If currencies go bad, then you can always have gold.
How is the price of gold? Why is price of gold not varying that much? I guess because there is a limited amount of gold on the planet Earth, and what is impacting the value of gold? How does that work?
So, what is really impacting the value of anything? At the end of the day, it's always institutional buyers and sellers that drive the price. And fundamentally, if you look at history, gold has always become interesting during times of socioeconomic and economic uncertainty. Okay, so for example, after 2009, gold just started to rally. And it went to $1,900, I think, $1,900 per ounce.
Because after the crash, everyone wanted to safer bet, and then
everyone wanted to have a safer bet. So now gold is at 2,000, which is an all-time high. So there's a reason why gold is priced at an all-time high. It doesn't really make sense, right? Because if you say, well, stocks are at an all-time high, it means that everything is fine. Investors are not worrying about the future. Everything's going to be fine. But you have gold showing the complete opposite, because gold making an all-time high is the embodiment of investors losing trust in the central banks who are printing money to an extent, infinity and beyond.
So if I understand this right, at the same time, we have the all-time high of stock market and the all-time high of gold. And the all-time high of gold is achieved when there is lack of trust in the stock market. But basically, how do we have a stock market at the all-time high?
Right, that's what we have to talk about. So and that's why you have overvalued stocks, right? That's why stocks fundamentally are overvalued at the moment.
For example, if we're talking about
Warren
today,
Buffett indicator, for example, yeah.
Like today's Google, Amazon, and are those overrated?
Those are definitely hyped up. Okay, so if they corrected a little bit, they would also be safe bets because they are sort of counter-cyclical stocks. Big techs are counter-cyclical stocks. They almost benefit from a crisis, right? Because they digest and they eat up all the smaller businesses and it makes them bigger. Like Amazon, for example, all the retail stores go bankrupt. Well, good for Amazon.
Right? Exactly, yeah. No, it makes sense. So what are other safe investing opportunities? We said gold is one of them, right?
So gold is going to be one of them. At first, you'll have deflation still. And with
back on the topic, we're jumping around 100 topics. We said deflation. We stopped at deflation.
Yeah.
Right?
So deflation first, and then gold is also going to be under pressure in deflation. Everything is going to be under pressure during deflation. It's just due to the nature of deflation, because during that time when markets crash, the general need for liquidity is just higher than having something, some of your money stored in gold or silver or stocks. You just need the cash, right? Cash is king. But you also have a big deleveraging effect, which means that, mutual funds, asset management firms, money managers, they invest a lot of money with leverage, meaning they borrow money. And they invest with more capital than their actual deposit. So it could be as much as 10 times. So if they have $100,000 as a deposit, you can have 10x leverage, meaning they actually have $1 million in the market.
Wow.
So if the markets drop, and we've now seen that the markets drop a lot faster than they rally, because fear is just stronger than greed. That means that if the markets drop faster, that's called increased volatility. And with that, you get margin calls. And margin calls mean that these money managers have to liquidate their positions because they're trading with borrowed money.
All right. And
so they have to liquidate it, meaning they sell off. And then they're selling. And they're selling, not just they're selling, also people like us who are then shorting, who want to benefit from the crash. Right? Or maybe hedging some of our positions. And then you have these three big effects that are creating all the assets to suffer. So gold, silver is going to go down because these money managers then take out money, not just out of stocks, but then they have to take it out of gold, they have to take it out of silver, and everything is leveraged. That's why everything is going to go down at first.
Until it stops at one point.
And then very likely what's going to happen is the Fed will do what they always do, the Federal Reserve, printing money, right? There's a problem, let's print money. So very likely that they're going to print even more money, that, the $3 trillion that they poured into the markets now is just a needle in the haystack. So they're going to print even more money to an extent where this may cause inflation. And then you may go into an inflationary period. And timing that is going to be extremely tricky because everything is going to flip. Instead of everything falling, everything is going to rally because of just the abundance of money.
Who controls, who makes these kind of decisions? The biggest economies, or there is on a global level, or how does it work?
The central banks can make those decisions. Yeah. They have to get it approved by Congress, but it's all one. So if the central bank says we need to pour money into the markets for XYZ reason, then they're going to do it.
Yeah.
Right. And so the problem with that is you have all this money that at some point is going to be circulating in the system, and you actually have less production. So that's the recipe for inflation. And if you've been toilet paper shopping recently or pasta shopping, you can see marginally inflation already. Things cost. So inflation means you have the same money than you had yesterday, but things are going to cost you more. So your purchasing power is going to be less. So if you have your money in the stored in the bank or under the mattress in form of cash, you wake up one day, inflation hits.
Devalued.
It will be devalued. And then, of course, inflation can be mild, but it can be very, very severe as well. It's tough to predict, but it could be severe. And how would you see it that it's going to be severe? You would see it reflected in the gold price. Because at that point, gold is going to go, every day you wake up, $100, $200. You wake up the next day, gold just rallies $200. Again, the next day, gold just rallies. That's a sign for you, something is happening. Let's not have cash. Let's put it somewhere else.
Yeah. Okay, now you got me worried, and probably a lot of people watching, they're getting worried and thinking about their cash under the mattress. I'm gonna wait a second. Can you put that in a bank? But like, if you're thinking about next year or two and thinking about investments, obviously there is a lot more that you can just tell us. Okay, you should do this or that. But are there some general principles, things that you should pay attention to, the things that you should avoid, like assets that you should avoid or pay attention to?
So things that you should do, a safe way of investing for me is always a calculated approach to investing. So never put something into a market, blindfold myself, and just hope to God that it's going to go up without having a calculated risk in place, knowing how much am I going to lose potentially, how much am I going to make? Because as I said in the beginning, everything is really possible, right? So we've seen scripts in the past where markets dropped 80%. Can happen, of course, can happen. The grounds are ripe for something like that to happen. Now the Fed is going to do everything in their power for this not to happen. So, but yeah, that's a safe way of investing. If you had asked me maybe 3 years ago, my answer would have also been different. I would have said, diversify yourself, stocks, bonds, some precious metals, gold, silver, you'll be fine. But now, because deflation, inflation, this flip where basically everything is dropping, everything is rallying, diversification doesn't help. Because it doesn't matter what you own, it's going to drop
everything
in value.
Goes down, everything will go up.
And then everything will go up. So at first, the only way how you can make money is really through shorting. Or even protecting yourself through shorting. And you can have something called stop losses, which are order types. You can basically say, I'm invested in Apple, I'm 20% in the profit. If it now drops 10%, I want automatically out. You can place these kind of orders, which would be ideal for you to protect yourself, of course, your running capital. And then inflation, for me, the winners will be for sure gold and silver. Silver even more than gold. Silver is at $20 now. It could go to $40, $50, even higher.
But at the end of the day, no matter what you decide to go for, all of this, we're talking about short term. You need to be active, I guess, in the market, and it's all about the right timing and reading the charts. It's very much about the timing because it's so uncertain how this all will unfold, right? And there's so many junctions where I can go left or right, and depending on what we see at the time, we then choose to go either right or either left. But the general thing that you should be following is deflation, inflation. And then there are just in general a lot of things that I would avoid. Like, for example, I would avoid broad market indices, like the German DAX, for example. Because Germany is also in the worst recession since World War II. And the German DAX is at the all-time highs, close to the all-time highs. Wow.
It has no business being up there. Plus, you don't have big tech in there. You don't have Amazon, you don't have Google, you don't have Microsoft. What does Germany really have? Automotive, But
Which
then,
is, yeah.
But then you have Tesla, which is perceived to be the winner of tomorrow,
Yeah.
just given the high stock valuations, and automotive, which is perceived to be the losers of tomorrow.
Yeah.
So I would stay away from just broad market indices in general. I would stay away from mutual funds. That's something that anyways underperforms indices like S&P 500, comes with high fees. That's something I would avoid.
So mutual funds, even on this long run, you would avoid?
Even on the long run, because mutual funds generally come with high fees. And also they generally underperform a simple stock market index like the S&P 500, which tracks the US, even during recessions. So if you want to invest in the long term, no mutual funds. I mean, we have a big topic about mutual funds in one of our free courses on online trading campus. So if your listeners link below, if your listeners are interested in mutual funds or investing in general, a lot of great, online learning content for free. You just have to log in, register, leave your details, and then we can take it from there as well. Yeah.
Cool. Jan, for me, extremely insightful and a big learning curve. I'm going to bother you a bit more after the episode is done. But what we need to do now, before we call this episode to an end. So last year we talked to Bernd. He made a prediction. Now I need you to make a bet and a prediction for the next 6 months to a year. You make a decision what do you want to predict, but it needs to be measurable.
It needs to be measurable.
You need to call something. You said deflation, inflation is going to happen by the end of the year, for example, or around the end of the year.
Just deflation hitting in that could take a long period of time as well. So again, that's very tough to predict beforehand, but I would definitely be a big fan of saying gold and silver are going to be a lot higher as they are today.
A lot higher meaning?
Meaning, I mean, if we enter the inflation phase, silver could be at, $30, $40. Gold could be at $2,500 maybe.
We have a deal. It's on the camera now.
It's on the camera, so it's on the mic as well.
Cool. Thank you for coming. Guys, I hope that you enjoyed, that you learned something new as well as I am. Make sure to leave comments below and to reach out directly to Jan or to me. We're going to leave the link to Online Trading Campus in the description below. Make sure to visit the webpage and learn more about what these guys are doing. And stay tuned until the next episode next month. Thank you, Jan.
Thanks for having me. Cheers.
Thanks, everyone. Bye.